value. Think about it. If we have the stock trading at 40, a strike price that would be less than the stock price might be the 30 strike. The 30 strike, if I owned it, the 30 strike put would give me the right to sell that stock at 30. Why would I want to exercise my right to sell the stock at 30 when it's trading at 40 in the open market? Why don't I go straight to the open market and sell it there? Sell it for 40. Obviously, I wouldn't want to exercise my rights to sell it at 30. I'd be losing money doing that. This option thus is not in the money. There's no instant satisfaction. This option is out of the money. It has only extrinsic value. Take a look at the chart of our put. You know what? It looks very similar to the chart of our call, just bent in the opposite direction. If we look to our top left, we see our unlimited potential gain as the stock drops. We know that in theory, technically, it's kind of limited because the stock can't drop to below $1. But in essence, and for the concept, we have an unlimited potential gain here, showed in that top left. Meanwhile, in the bottom right, being an owner of an option, a put owner here, we know that we're going to have a limited potential loss. That bottom right shows that arrow turning right and going sideways, no matter how much further up the stock goes. Our long put can't lose any more money than what we spent on it. That's the most we can lose. So we have a limited potential loss. And that's what that arrow pointing to the right, pointing sideways down at the bottom right is showing. We know that that little inflection point where we kind of hockey stick it almost looks like a hockey stick, that beginning of that curve of the hockey stick there. We know that that's the strike price, the point of what? Maximum loss. And the point where the red line meets the black line, that's going to be our break even for the put. Now, the break even calculation for the put is similar, but not the same as the call. Remember, we said the break even for the call was what? The strike price plus the call price. Here, for the break even the put, we're just going to move the opposite way. We're going to look at the the strike price minus the option price. Strike price minus option price for the break even of the put. Let's throw some real numbers at this. Let's buy one XYZ May 40 put for $2. When you look at our chart, you see our top left. There's our arrow heading to the moon. We have unlimited potential gain down that way. And off to the right, bottom right, we see that our red line, our arrow starts to go what? Goes sideways after a while. And it continues going sideways no matter how far up we go. That indicates to us a limited potential loss. If we buy a May 40 put for $2, we know we can only lose what we spent. Our maximum potential loss is the $2 we spent for the option. We see our inflection point at the 40 strike. Remember, we said any time you buy an option, the worst place for that option to go or the stock to go is directly to the option strike. That is the point of maximum loss. And take a look at our break even, $38. Remember our formula. Strike price, 40, minus option price, 2, equals 38. 38 is our break even. If we own this put into expiration, May expiration, and the stock closed on Friday of expiration at 38, that put would have $2 of what? Intrinsic value. That put will be worth $2. Why? because I have the right to sell the stock at 40. That's what my long put's allowing me to do. Have the right to sell it at 40. I could then go out and buy that stock back on the open market for 38. That gives that put a value of $2. I had sold the put a while ago for $2, and now with the stock at 38 at expiration, it's worth $2. I have not made nor lost money. That's why it's a break even. Well, this concludes introduction to options. Now, obviously, there's way more to learn about options. I'm not trying to spook anybody. I'm just trying to keep it real and give you the realistic, scoop here. Fact of the matter is, you're not going to learn how to use options overnight. You're not going to learn how to use them properly over a weekend. You're probably not going to learn how to use them properly over a month. But you know what? It's not medical school, and it's not law school. Most individual investors, if they put some time, effort, and energy in and take a good class, normally, we're seeing our students becoming consistently profitable. Not always profitable. Consistently profitable after about a year to a year and a half, depending on aptitude and how much work you want to do. So it doesn't take you forever. Many of my students actually start making money in the class that they're in. I try to tell them to wait, but you know what? People are impatient. They learn a strategy. They say, hey, wow, that's a great strategy. I like this. Let me start using it. And boom. But the fact of the matter is, it's not going to take you a lifetime to learn options. You can learn them properly, the right way, in a relatively short amount of time. So if you're interested in finding out more about options and how to use these things properly, then hey, take a look at some of our classes here at Ion Options. My name's Ron Ianieri. Thank you for your time, and I look forward to seeing you in one of our Ion Option classes coming up soon.